The broadcast is now starting. All attendees are in listen-only mode.
Welcome everybody to the National Housing Resource Center Leaders in Housing Counseling call. We're going to be starting in just a minute. We'll be with you in just a moment. Thank you. Okay, welcome everybody to the National Housing Resource Center and our Leaders in Housing Counseling call for today. We've got a good packed agenda, a lot of ground to cover, and we've had a very busy week last week especially, so we want to give you highlights from our visits in D.C. We're going to talk a little bit about the impact of the federal shutdown on housing counseling agencies and how you might be helpful in the future on this. We had a big breakthrough on tracking counseled mortgages, which we think we're very excited about. We have, we'll give you the federal funding update. We have Donald Coren from FHFA about their streamlined modification program for Fannie Mae and Freddie Mac loans, which has been available for a little bit, but I guess many of us don't know about it, and this is an opportunity to help more clients. And we're going to do a rundown on the housing finance reform that we're seeing going on on the Hill, what we learned from our visits and where that's going to lead in the future, which we think this is a real opportunity to integrate housing counseling more effectively into the mortgage and servicing process. A lot of very good opportunity there. You know, there's been a lot of discussion on our listserv about our relationship with HUD, housing counseling agencies' relationships and reporting requirements and things like that. So we're going to pull together a task force for people to put their heads together on this, so you can volunteer for this. We'll have some news you need to know as well, and the latest breakthroughs on settlements, what's happening with the file review, especially with the OCC, a lot of good things like that. But let's dive in. So first thing on our list is, well, the shutdown is over. So Matthew, can you help us tell us what happened here and how it impacts us?
Yeah. So at the end of, I guess, Wednesday, Thursday of last week, at the 11th hour, the House and Senate came to an agreement to fund the government through January 15th. And to avoid defaulting on the debt ceiling, which is not super pertinent to us, but was a pretty big deal in its own right. Do you want me to go into detail now, or do we want to?
Yeah, let's do it now.
Okay. So so the kind of outline of the agreement. So like you said, it funds the government through the 15th at $986 billion. So that is a lot closer to the level the House was looking for. It's essentially FY 2013 level with the sequestration cuts included. The House had been pushing for the much lower number of $967 billion. The Senate was pushing for $1.058 trillion, which was basically would have been on the level of if sequestration didn't happen. So that number is much closer to the House level, which is obviously bad news for us. But the good news is that the Senate resisted, and the Democrats in the Senate resisted a longer deal because they really want to kind of dig in their heels and have a fight over what that number is. They want to push for undoing sequestration and try to get it, if not up to that full $1.058 trillion level, at least a higher level. So the good news is that the Senate is going to push back on that spending number, which obviously the higher the number, the more money there is for HUD. and for housing counseling by extension. So the kind of next steps, so now the House and Senate with Republicans and Democrats from both branches, or both houses rather, are going to be meeting in a conference committee, basically just trying to work out negotiate an agreement that will fund, ideally they're going to try to work something out that would fund the government for the rest of FY 2014. They're supposed to reach an agreement by December 13th. As we said, the Democrats are going to push for raising that spending number, undoing sequestration completely or in part. The Republicans are going to look for concessions, essentially look for saving long-term savings in exchange. So it's kind of unclear what's going to happen with that. But the summary is that right now we're looking at the FY 2013 with sequestration levels. Likely that's the lowest that the number is going to be going for the rest of the year, and there is some chance that maybe that number gets pushed up. And so the funding is $42 million more or less for HUD housing counseling, and about $77 million for NFMC funding in the short-term agreement, and that is at least what it will be in a longer-term agreement.
Good. And then on the shutdown, one thing, we got an interesting request from HUD. They would like us to just document what the impact on the shutdown had on our agencies. And the idea is that there may be times in the future where shutdowns are threatened again, and this would give them an inventory to be able to say this is what the impact is if we have a shutdown in each of the HUD programs. And so certainly we'd like to have stuff for housing counseling. So if your agency, for example, needed to bill and wasn't able to bill during that time, or couldn't get the locks drawdown to be done in time, if there were other things that delayed because of the shutdown, it'd be great if you could communicate that with us. We'll pass this on to HUD. These could be, and you could either put it in the chat box now, or you could shoot it to Matthew. His email address is on the slide. But I know some of you already memorized his email address because I know there's more traffic happening. But it would be great if we could get any responses you've got about how your agency was impacted by the shutdown. Good. So many of you who've been following these calls know that one of our projects has been to properly track whether a mortgage has been counseled or not. And if that can be built into a comprehensive tracking database that might include not only whether a loan has been counseled, but how it was underwritten, whether how the loan is performing, delinquency rates, and things like that. This would be a great opportunity to map out the impact of housing counseling and be an opportunity for people to be referred back to counseling if they were counseled in the pre-purchase process and then had an event happen that caused them to be delinquent, that they might be able to get support from the counseling agency. And potentially there's other things, and more sophisticated things that could happen in the future once we start quantifying these. It's been an important issue for us, and while we've gotten a lot of people to say it's a great idea, the big problem is how do you build it into the system. And we had a very good conversation with FHFA months ago about this, and had been talking with them on the phone. We had a meeting last Thursday with FHFA, and they told us that they are incorporating the system. They are going to have data fields that will match the data fields that HUD is using on their home ownership certification form, and so that there won't be any extra data fields to be done. These will be data fields that are already being collected and reported, and these would be incorporated into the mortgage application that will be used by Fannie Mae and Freddie Mac. So I don't know what the timeline is about how soon this all may happen. It's all in the works still, and it's on the planning stage. But the nice breakthrough is that we seem to have made a huge leap forward in terms of integrating housing counseling into the reporting system this will make a lot of our work easier in the future in terms of showing the success of housing counseling. So hats off to FHFA for doing this particular piece. But I'm very glad, and a lot of you on the phone have worked on this issue or raised it in different contexts, and hey, got a breakthrough, we're moving forward. Okay, so we have a guest today on our call. It's Donald Coren. He's from the FHFA, and he's here to talk to us about FHFA's streamlined modification program, and it's the opportunity here is that this requires a lower level of documentation and can be done relatively quickly, and she doesn't need documentation in the way we traditionally think about it, and it's an important tool that council should be aware of. So we wanted Donald to give us the background on this, and we sent the materials on this when I sent the agenda right before this call, and it also went out yesterday as well. All right, Donald, are you with us?
I am. Good afternoon.
Excellent.
Thank you, Bruce. In July 1st of this year, this became a requirement for all Fannie Mae and Freddie Mac approved seller servicers. And the servicers were to actually search their databases and offer to borrowers who were 90 days delinquent with a FICO score below 620, actually send out a solicitation for a modification. It requires no hardship, it requires no finances, it requires no questions at all. So the solicitation started going out in July. We are getting tremendous response. And so I think as housing counselors, you should know that this product is out there. It is a fantastic product on many, many levels. We know that through all of our research that obtaining the financial and the hardship documents and keeping those documents, in a timely manner was a huge hurdle to getting people into modifications. So this completely alleviates that. To date, I would say I think there's close to 60,000 trials that have been started on this. This is a solicited offer. I mean, it is a proactive move by the servicer running through a bunch of eligibility criteria and then offering this. A borrower can either call and accept it, or if they don't even want to talk to their servicer, simply send in the first payment. If they then make those 3 consecutive trial payments, their loan will automatically be turned into a permanent modification. So how does the modification work? First of all, it'll take whatever arrearages they currently have, capitalize those. It drops the interest rate to whatever the posted standard modification rate is for Fannie and Freddie. Currently, that is 4.625, and it will remain that through the end of the year. We only adjust it quarterly, so it is 4.625 through the end of the year. And then it will see if the borrower has an LTV over 115%, their mark-to-market LTV, it will forbear down to 115% and then extend the term to 480. We have found that on average, that drops the mortgage payment from 30 to almost 50% in some cases. So it's a fantastic way to keep people in their homes. So if you aren't aware of this, what I suggest as a housing counselor is to check, first of all, ask your clients, have you received this modification? If they haven't, let's check their eligibility to see if they should be receiving it and getting it. And I'm just going to go through some of those eligibility criteria so that you're aware of them, and then I'll take any questions you may have. First of all, they have to be at least 90 days delinquent, up to 720 days delinquent. That's up to 2 years delinquent. So if they're over 2 years delinquent, this is not a product for them. But if they're between 90 and 720 days, that's the first hurdle. The second is, what is their FICO score? If it's 620 and below, absolutely. That implies a hardship. So there's where the hardship comes in. We're not asking about any finances. We're not asking about anything else. We're just saying, okay, those are your 2 criteria. It has to be a loan or a mortgage that is owned by Fannie or Freddie. It has to be a GSE loan. So that is the other one. If this is not a private label deal, this is only for Fannie and Freddie loans. The loan must be at least 12 months old. So, you know, it can't be a loan that was originated 3 months ago and now they want a modification. No, it has to be at least 12 months. The principal and interest payment must be equal to or less than what they currently have. And as I said, that would again depend on the arrearages, but in all of our trials and working with this, it really drops that loan usually 30% at the lowest, 20 to 30% up to about 50%. So that should not be an issue. All kinds of properties are eligible: primary, second home, and owner-occupied investment properties. A vacant property, even though if it's condemned, could still be eligible for this. So those are the eligibility criteria. Now I want to give you some idea of what causes people not to be eligible. And so that is something you need to check when you're looking at your clients. If that loan has already been modified 2 or more times, ineligible. So in other words, your client has had 2 modifications and now, again, they're trying to get another modification. No, we're not going to accept that. This really is a lifeline to those borrowers who are not responsive to who are not responsive to servicer calls, who maybe are in a situation, let's just talk about a multi-generational situation where in the family, the person who actually owns the mortgage lost their job, but the children and relatives live in the house and they can all pitch in to pay that mortgage. And you know, in a regular world, that would not qualify in a documented mod. But in this case, fantastic, no questions asked, as long as you can make that new payment. So this eligibility then exclusion is if it's been previously modified 2 or more times. If the mortgage is currently subject to something like a short sale or a deed in lieu, not eligible. If it's currently in a modification offer and they're performing, it's not eligible. They have to finish that one. If the loan has recourse or indemnification on it, and you may not know that as a counselor, but the servicer would, it's not eligible. And then, of course, it cannot be a loan that's owned by FHA, VA, or a guaranteed rural housing mortgage. It just must be a Fannie or Freddie Mac loan. The only other things that you can currently look at, again, so the keys are FICO, delinquency time, any previous modifications, is it a Fannie Mae or Freddie Mac loan? Those are your big ones. And if you can see that your borrower has all of those in place, then they're probably going to be eligible and should be solicited for this. There is one other eligibility criteria, which is a priority. Fannie and Freddie Mac both look at these loans and have an exclusionary list. And I will tell you that list is based on taking a quick look at FICO and payment history, as you would. And this is to make sure that we screen out any people who are strategically want to default just to take advantage of what they would call a free refi. It's not really a free refi. It's a modification. And as you know as counselors, anytime you get past 90 days delinquent, you have a true impact to your credit score, usually almost about 150 points. So it should not be there. But if you've got a client who's had a high score and they've paid all of their other bills except they decided, I'm going to stop paying my mortgage to see it, they would be excluded from this type of an offer. So those are the borrower eligibility criteria. Again, it is a solicited thing from the servicer, and in the actual solicitation, it gives the dollar amount that your loan will be. So again, it looked at it, it has changed the rate down to 4.625. It has capitalized any arrearages that you have. If you are over, your mark-to-market LTV is over 115%, it'll bring it down to 115%, around 30%, and then it extends the term to 480, and it tells you this is your mortgage payment. The borrower simply makes 3 of those payments on time, and the loan will be permanently modified. That's it in a nutshell. It is a true lifeline to people It's a last chance effort to keep them in their home. Once that loan is modified and they're performing on it, you know, their credit goes back up. They can sell it as the market is improving. It buys them, you know, retention in their home. And it's the last suite of our streamlined products for home retention or alternatives to foreclosure. We also have a streamlined short sale or deed in lieu that has basically the same criteria. If you do not want to stay in your home and you have a FICO of 620 or less and you are 90 days delinquent, you can then choose, I don't want to stay in my home, I want to do a short sale, or I just want to hand over the mortgage, release the mortgage. That is also possible with that criteria. So I hope that, you know, sort of gives it in a nutshell. I'll be happy to answer any questions now, or Bruce, whenever you want at the end of your presentation, just let me know.
Yeah, great. We actually, this is
Let me ask
Matthew.
a couple questions really quickly. Just I think that will be helpful to sharpen this up a bit, and then we'll take other questions as well. So first one is, if, let's say somebody has a client and they got the solicitation in July, will they be, is there a time limit on when you have to respond to the solicitation?
There is a time limit on their solicitation. It's within 1 month. So if they were solicited and they didn't accept it, they will be solicited again. The requirement is that servicers solicit their entire book at least once a year, but many servicers have said that they sort of do it every few months or so. If they were solicited previously and they didn't accept it and now they want to or they realize it is, they should call up their servicer, tell them they originally received it and they're really interested in it again. That servicer then will recalculate, because they probably have more arrearages now, and probably send them out another solicited offer if they want.
And then the second question is, I think we are often working with a client around a specific modification, and it may be that it's a lower rate and maybe a different term than what you described. And would it make sense for people to move forward on your on the streamlined modification and then continue to be able to work with Fannie or Freddie about getting a modification that might be deeper to match people's incomes?
Absolutely. So, you know, with a complete borrower response package, which has your financial and your hardship documentation, in our hierarchy of evaluating people, and this also matches the new CFPB laws that will start in January of next year. If you submit a complete application, you are going to be evaluated for the best mod, which is currently a HAMP modification, which is based on a debt-to-income ratio down to 31%, and then you can adjust the interest rate as low as 2% in that case. Yes, you can, if you get the solicitation, and many people do this, let's say they've gotten the solicitation, they can go ahead and start that solicitation, and then within the next, before the final trial payment, that gives them 2 months, if they get in their complete BRP, borrower response package, with all of their financial and hardship documentation, that servicer is required under Fannie Mae Guide and Freddie Mac Guide to evaluate that borrower for the better option. If the borrower is eligible for that option, they will be converted then to the HAMP option, or the better modification. But it has to be within that 2-month trial period. Once they hit the third trial payment, they will go immediately into a permanent streamlined modification.
But that doesn't preempt them from getting the better mod if it works out over time.
No, that's what I'm saying. It does not preempt them. It does preempt them if they don't send their package in.
Right.
So, for example, if you've already gone to a streamlined mod after your 3rd month and you're in your permanent mod, sending in a HAMP modification is not going to work because you've already been modified. So you have to do it within the time periods before permanent modification takes place.
Good. So Matthew, we had some other questions in the queue?
Yeah, and I'll also just say that apologies for not having this information on the slide. It was a little bit of a last-minute addition, and there have been a lot of requests for that. We did circulate some information beforehand, and we'll recirculate it after. But so just everyone know that we will have some written information with some of the details. But just specific questions. Could you just clarify the servicers that are participating in this program?
This is a guide offering from both Fannie and Freddie, so all approved seller servicers for Fannie Mae and Freddie Mac are part of this program.
All right. And I think you went over this, but if you could just again, are borrowers being automatically reviewed, or does it have to be specifically requested?
No, they're being automatically reviewed, and if they fit the eligibility criteria that I went over, they are sent a solicitation letter telling them they can take this modification if they want by either calling the servicer within 14 days or simply sending in the first trial payment by a certain day. The letter is very clear on the amount and the day to send it. It also says if you wish to be evaluated for something better, call up your servicer and we can send you a borrower response package that you should submit, you know, hardship and financial documents, and we'll evaluate you for something else. But in the meantime, you can start this trial program to stay in your home. It immediately, what it does, it really stops the foreclosure process. You can actually start this, you know, by day 90, by day 120, and everything is stopped because you are in a trial program at that moment.
All right. Is the program available for rental properties owned by Fannie Freddie?
No, it is only available for, I mean, if somebody's renting the property, yes, is available for it, but not for somebody who's renting the property. The owner of the property, yes, of course.
And it's available for single family.
Single family.
Right, not multifamily.
That's correct.
All right.
2 or 3 unit building would be still eligible, right?
Yes, yes. Yeah. A 2 or
Right.
3. Yeah. Mm-hmm.
Is LTV accounted for when they're
Yes,
factoring eligibility?
Right. You have to be, I'm sorry, your LTV must be 80% or greater.
All right. Is payment escrowed?
If your current payment, taxes, and insurance are escrowed and that account is in place, that account stays in place. If you do not have it, the servicer is required to set up the taxes and escrow. The payment that is sent to the borrower is the total payment. It includes everything.
All right. Have all the offer letters been sent to eligible homeowners, or are the evaluations still ongoing?
No, it's still ongoing. Servicers have started to adopt it, you know, since July, so they've sent out their first wave, and they do it in batches. So there's a constant, you know, people are going delinquent. They start at 90, and they're looking at those, and then people who are currently delinquent, there's greater than 90 days. They're running through their systems and generating those letters. The letters, again, are calculated and personalized with an exact payment for that borrower. So it continues on and on.
Great. So if a homeowner has the streamlined modification, would they then lose the streamline when they apply for HAMP?
Yeah, if within the time period before the third trial payment comes in, they send a complete borrower response package and they are eligible for HAMP, they will then be put into a HAMP trial plan, and they make those trial plans, and then if they perform, they will be converted to HAMP. You can't have 2 programs running at the same time. It will be either this payment or that payment. So yes, a HAMP would replace the streamline mod.
Right. Great. I think we know the answer to this, but is housing counseling a requirement from the servicer?
It is not.
Right. So there's one person's expressing concern that that because the letter is saying that to make a payment to accept the offer, people may think it's junk, and so they're asking, can counselors call and ask if borrowers are eligible?
Well, you can call the servicer. I would say look at your borrower first and ask them, have they received the letter, and did they throw it away or not, as I said, and if they did, have them call their servicer. And then looking at what the eligibility is, and you can go on to either Fannie or Freddie's website, and it will give you all this information about how it works and what's available and what isn't. You can you can see if your borrower is going to be eligible or not. If they're not eligible, they're not going to be solicited. I mean, if their LTV is less than 80%, it's not possible. If their FICO is 650, no, it's not going to happen. But if they're not, yeah, you can then say, I have a borrower who I think is eligible for this. Would you mind checking? Has that letter going out, or is a letter being drafted for them, or whatever? Again, servicers are doing this in big batches at a time. They started actually sending out the surveys, the solicitation letters in like mid-June, because it became law, or became a requirement for the enterprises on July 1st.
Okay, and this is related, but what if a counselor has a client who meets all the criteria and has not been offered this option? Should they contact the servicer,
Yes.
Fannie or Freddie, to see if they're eligible?
Yes, they should contact their servicer and say, I've heard about the streamlined option. I believe I am eligible. Can you check, and can we, expedite this, and see if the servicer is, it may be that they just haven't gotten to them alphabetically, or however the servicer is doing this. One thing I did mean to tell you, this program ends on December 31st, 2015, and so does HAMP. This is running the same time period as HAMP. HAMP is a fully documented modification. This is the no questions asked modification.
All right. I think there's a little bit of confusion maybe about the kind of intersection between this and HAMP. So could you just clarify that a little more? The one specific question is, how is it determined what program they go into? Are they reviewed for this first, then HAMP, vice versa, or another internal product? So could you just clarify that for us?
Certainly. So you know that FHFA back in 2011 made Fannie and Freddie do what we call the Servicing Alignment Initiative. And these are protocols and requirements around how servicers should deal with delinquent borrowers and loss mitigation in general. And it deals with borrower communications and all kinds of things. Well, so in that, what happens is when a borrower starts delinquency, at day 31, servicers are required to reach out and call those borrowers every 3 days. Every 3 days, a call, trying to get what we call quality right party contact. At day 36, they send out a letter with an actual borrower response package in it for the consumer to fill out. And the calls continue. They send out another package at day 61. So these are all requests for information from a troubled borrower trying to help them. Say, well, give us, why are you having a hardship? Did you lose your job? There's all kinds of things we can offer. There's unemployment forbearance. There is a repayment plan if you just had a few months trouble. There's all kinds of things that we can do. Once a complete package comes in, and that means it's got all of the requirements for financial review, for hardship, that's when servicers then evaluate for the hierarchy. And the first thing they evaluate for is the HAMP. And if that borrower is eligible, they give them the HAMP. If the borrower doesn't quite eligible for HAMP, then they go down to, of course, Mod 24, which is a Fannie Mae modification that actually gives a debt to income less than 31%. So it's even more generous to a borrower. And if they're not eligible for that, then we have our standard modification. Those are all based on information that a borrower sends in. This mod is very different. This mod is actually a proactive means. It's not asking the consumer for information, it's offering the consumer a complete modification. So we're saying, we know you're at least 90 days delinquent. We can see that you have not been modded in the past year. We see that your FICO and your credits are way down. Obviously, you're having a hardship. We would rather you stay in your home. And instead of trying to track you down and keep calling you every 3 days, and you're not responding, do you want a modification? It is absolutely an amazing product. It is, as Mr. DeMarco calls it in the press release, a lifeline thrown to somebody, drowning in the ocean. It's take it. Take it because, my gosh, you're going to be modified. You can stay in your home. You can pay that mortgage. You can, if you're dropping your payment 30% and you can stay in that, who knows what will happen. As you see, house prices are moving up. The market is changing. Hey, in 2 years, sell your house. Move, whatever you want. But you do not have to go to foreclosure. It is truly a home retention lifeline. So that's what's different about it. It is a proactive means. We're not asking any questions. Just by the fact that you're delinquent and your credit has been impacted, we are assuming you need help.
Great. We have a few more questions. Do we have time to do it?
Yeah.
All right. Someone says in the past they had heard this product could be entered into at 60 days past due. Has that now changed to 90 days?
90 has always been our keystone on this. 90 days delinquent, absolutely. At 60 days delinquent, if you are in imminent default, imminent default indication that we think you're going to, you will not be offered the streamline, but you will be reached out to, and if you can provide more information at 60 days, and we will evaluate you for a HAMP or a Mod 24, something better. But we won't put you into a streamlined at that point.
All right. We have one question, which I think is a suggestion wrapped in a question, but did the solicitation letters suggest homeowner reach out to a housing counselor since budget counseling would be valuable to these homeowners?
It does not, but that doesn't mean it's not in the letters. Fannie and Freddie just gave sort of some model clauses on what the letter should say. Basically, it states, the terms, the new payment, and stuff like that. It doesn't say anything about housing counseling. Again, this is a no questions asked modification. By referring them to a counselor, all of a sudden you're asking questions again. This is a no questions asked. This is just a lifeline to get you into a very good modification, by the way, at a very good interest rate.
All right. Let's see.
I saw one question. Let me just jump in on the queue. One person asked if they'd been turned down for a HAMP mod, can they still get this one?
Sure. If they were turned down for a HAMP mod, I don't know the reason, though. It depends on the reason. They should have already been offered a standard mod or something other than that, unless they do not have a permanent hardship. So, for example, if, let's say you said your hardship was unemployment and you took maybe 6 months of unemployment and now you're working again, your hardship is resolved. So you're not really, you can't be put into a HAMP in that situation. You may, however, get a standard mod, but even if that's the case, you wouldn't give you a standard mod in that incident. The terms of the standard mod and the streamlined mod are identical in the sense that they still are 40 years, they are at the same interest rate, and they do have the same forbearance amount. So either one is good.
And there are a bunch of questions. I don't think we're going to get to all of them, so I apologize, and we can try to get to you offline if we don't. But is the term of a loan extended for the streamlined mod?
Say it again, please.
Is the term of the loan extended for this when it's?
Yes, 480 months, 40 years.
All right. What if the borrower has a second lien? Do they look at the CLTV for the 115%?
No, they're looking just at the first lien.
All right. What is the average time frame for the trial to be approved to become?
3 months. It's 3 trial payments. 3 trial payments. And you must make them on time. If you do not make them on time, you are then not following the program and you can be terminated and say you are not eligible for that mod. That is how that 3-month trial payment is the proof that that borrower wants to stay in the home and they're making all efforts to pay that mortgage.
Great. So we do, and I again apologize to folks we didn't get to. We will kind of follow up with you offline. There's some really specific questions that I think are probably better offline anyway. So I'll just say thank you, Donald, very much, and hand it back over to Bruce.
Okay.
Got a nice active response on that. That was great. So, so next phase in our conversation here today, we had very valuable meetings in D.C. last week around housing finance reform. This is the famous GSE reform to figure out what institutions might replace Fannie Mae or Freddie Mac. So Matthew, what's your summary on all this? What did we get? What did we accomplish?
Yeah, so just as a quick kind of recap, I guess, of the issues that are out there and why this is relevant for us. And this, we'll start off by saying that this conversation is really getting a lot of steam on Capitol Hill. But the kind of short story is that there's a lot of movement on Capitol Hill and on both sides of the aisle, folks that would like to see Fannie and Freddie be replaced. There's a lot of debate about, the debate is about what's going to replace Fannie and Freddie. There's a small number of folks who would like to see Fannie and Freddie continue, but that they're in a minority. So it looks fairly certain that they are going to be replaced by something. So our goals and what we're trying to bring to the conversation really are two things. First is we're working on getting housing counseling embedded into this process. So that's something we've been working on, coming at it from a lot of different avenues. And we see this as a really great opportunity to embed housing counseling into the home buying process. It's a little bit tricky because this is concerned primarily with the secondary market, but there are a lot of ways that housing counseling can be built in. Our second concern is with on issues of access and affordability. Now, I'm sure you all know Fannie and Freddie have the affordable housing goals, which have done a lot in terms of making mortgage credit accessible to all credit-worthy borrowers, and we're fighting to make sure that that in whatever model emerges to replace Fannie and Freddie, that access and affordability are front and center and really explicit goals for whatever entity emerges. So we were on, as Bruce said, we were on Capitol Hill last week. The shutdown slowed us down just a little bit, but we did actually have meetings with a lot of important folks in this debate, including staff members from Senator Martinez from New Jersey's office, Representative Cummings, who's really been a leader and an ally for us on all kinds of housing issues, folks from the House Financial Services Committee, from the Democratic staff members from House Financial Services, and really most importantly with both the Democratic and Republican staff members from the Senate Banking Committee. So right now the Senate is primarily where the action is happening, and specifically in the Senate Banking Committee. So it was great. We had a meeting with probably 20 or so people in the room, a lot of representatives from the housing counseling community, sitting down with staff members from both the Democratic side and the Republican side. Had a really great conversation, and really in all of our meetings, we were very well received. A lot of support certainly for housing counseling. Two of the areas that we feel like there's particularly a lot of traction are around, so there's a bill called Corker-Warner that's kind of the baseline bill for a lot of these conversations. In that there's a 5% down payment requirement, and there's also a requirement that eligible mortgages that the borrower have no more than a 43% debt-to-income ratio. One of the things that without trying not to get too far into the weeds, there seems to be a lot of support for the idea that housing counseling may be a tool that would help borrowers go below that 5% down requirement, or possibly go above that 43% debt-to-income ratio requirement. So that's one area that we've seen a lot of support for. The access and affordability issues, that kind of goes down party lines. We got a lot of support for that from Democrats. Republicans were kind of respectfully disagreed with the idea that access and affordability should be included, but that's certainly something that we're going to continue to have that conversation.
And then that's actually just to clarify. So the issue is that Fannie and Freddie used to have or have goals that they have to meet that are low and moderate income affordable housing goals. And the new legislation doesn't include those goals, but talks about aspirations to hit that. And when we were talking, I know some of you know that NCRC has raised this issue pretty dramatically, and others as well. When the question came up about doing more specific things around affordable housing, that's where one of the Republican staffers said that they weren't in the same space as we were on this particular issue.
Right. So again, just to kind of summarize, the meetings on the Hill were very productive, and really the most important conversation that we had was with the Senate Banking Committee. And what's been especially encouraging is after the meeting they reached out to us, said they had really found it valuable and appreciated hearing from the housing counseling community. And so we've done a series of follow-up meetings this week. We had a conversation on Monday where we got into a lot of the servicing issues. Servicing is going to be another big part of this. And we flagged a lot of the issues that the counselors have been bringing to us about what they're seeing in the field. And they, again, were very interested to hear. Then just this morning we had a conversation about underwriting, really about the 5% down and the 43% debt-to-income ratio that we talked about, but they were interested in diving a little deeper on those issues. And then coming on Tuesday, there's going to be a hearing specifically addressing consumer-related issues and concerns around the housing finance reform debate. And Lot Diaz, who some of you may know from NCLR, is going to be testifying. So it's really encouraging that they want housing counseling to have a voice at that hearing. So just to kind of summarize, it's been a really encouraging. It's a long-term debate. There's some hope that they'll get a bill out of the Senate committee this year, which may or may not happen. But really, this is a long-term kind of item. But it's very encouraging that housing counseling is being well considered in the process.
Yeah, there's a lot of participation by many groups. A number of people came from out of town to participate in these meetings. We really appreciate that. There was, as Matthew said, a lot of recognition of the expertise on the ground, of people knowing directly what was happening. And the nice thing was that that Lot will be representing the housing counseling community. They specifically said that they wanted a slot for housing counseling in the consumer panel, and that's the kind of level of participation that we really want. So that was a really good news. So hats off to everybody who participated in that. There'll be plenty more coming up in the future. So as many of you know, there's been these back and forths on our listserv about issues around HUD and paperwork and reporting requirements, the PARS, the Personal Activity Report. And we thought that this is going to be an ongoing issue that we need to address. Some of you may know Afreen Alam, who is at the National Urban League, and she has worked with other agencies in the past. So she has volunteered to help head up a task force that will be specifically allow us, us being all of us, to have a conversation about what we would like to talk to HUD about. And so this could be reporting systems, this can be efficiencies, this can be all the mechanics of our work and our relationship with HUD. The certification issues, the training issues, all those things that people have been really concerned about. We thought we need to have a sort of a deeper dive. We want to have some practical solutions. We want to recognize what the constraints are that HUD is working in. So the idea was, let's pull together a task force. Let's get our best thinkers together to start working on what our proposals will be. Hopefully this committee will also help work on a comprehensive response to the proposed rule that's due on November 12th. But the goal here is to really be able to have an ongoing conversation first among ourselves and then with HUD about what can be done to make the relationships work better, make the manage the reporting requirements more effectively, deal with all the various hiccups, the communications problems, the HCS problems, all that sort of stuff. We know you got a lot of experience out in the field, so for those of you that would love to engage in this, please let Matthew know, and we'll pull together the first meeting of the task force soon, and look forward to making some progress on important issues. On top of that, let's just say there's lots of good things that are happening out there. A big breakthrough was with Chase, and the Department of Justice has done a multi-billion-dollar settlement, $4 billion of which will go for homeowner relief. We have been able to submit to them proposals around funding housing counseling and legal services, around funding outreach, and around better servicing standards, and potentially doing some creative things like helping high-impacted communities by creating, mortgage pools that might, for people who might have who need to get a mortgage, but were impacted by the recession. So we don't know what will get traction here. We're not at the table. We're just talking to our friends who are at the table and trying to get these proposals in. So we'll keep you updated on it, but there is a lot of money that becomes available, so we're hoping that some of this can really help improve your work and get out into the field more. We'll keep you abreast as it goes on. There was a recent court ruling against Bank of America, really countrywide, the institution they purchased, where they actually convicted a senior bank official. Does look like there's a new posture with the Department of Justice about being more aggressive about some of these prosecutions and settlement negotiations. One of the things that was significant about the Chase deal was that Chase was required to admit guilt and not be able to say, not to do the usual, saying that they did not they did not admit to any guilt. Also just several reminders here. So we've got the FHA Back to Work directory. It's on our website. It's very easy for you to sign up. And we have gotten reports from several agencies now that they're getting a flood of calls. We are reaching out to the lending community to get them to publicize this. There's 75 plus agencies that are signed up right now, but there's room for plenty more. There's certain communities that are not covered at all. But this does have a real value to groups that are providing the counseling service. And one thing that we did was to provide a section in there where you can identify how much the lender should pay to get this counseling service. And so it sets up the assumption that they will pay for the service. HUD permits it but doesn't require it. And hopefully, we had a good conversation about this on the last call, and we're encouraging people to not do small token amounts like $50 or $75, but try to reflect more like what the costs might be, $250, $300, or whatever people feel is appropriate. And you can look at the at what other agencies are doing as well. But please sign up for this now, because we do want to promote it to the lending community, and we do understand it's working pretty well already. OCC file review. Boy, we need your help here. So a lot of you and a lot of us have complained about all the problems with dual tracking, with single point of contact, with improperly handled documentation, lost documentation, improperly calculated incomes. So the OCC said they're going to take their examiners and do a deep dive in these cases, and we have so far, I guess about 10 agencies have stepped up and submitted what seems to be a total of about 25 cases. That's not anywhere near where we want to be. So this is a huge opportunity. This is the first time they're taking complaints from counselors and having the examiners go into the files, compare what the counselors are saying to what the bank says, and there's two pluses out of this, one of which is hopefully we can get some of these cases corrected, and the second one is that the cases are that they can lead to systemic changes at the servicer. So we are, this is a really big opportunity. I know we've been asking a lot of you, and we had just gone through the HSBC cycle, so we didn't get quite the response we had expected. This is a really good opportunity. You don't have to just submit one case. Several agencies just submitted one case. Submit a bunch of cases. They submit them with different servicers. That's all very helpful. But we would really like to have a bigger response. I think the deadline is over, but we've got the deadline extended, and I'll figure out with OCC what the timing should be. When Matthew sends out his summary of the call and the links, we'll put that information in again. It's a pretty simple process to participate. You basically you send an email to Ted Wortel at the OCC. He gives you a passcode to get into their portal, and then from there you can start entering cases. So, anyways, please do that. We did have a pretty fiery round of meetings with HSBC. So we reported them to the Fed and had a very powerful meeting with the Fed about problems with cases. We got about 45 cases examined, submitted, and they've committed to examine at least 30 of those cases. They're not going to tell us the direct results because of their rules around exams, but we have asked them to at least give us a summary, and they're considering that, so hopefully we'll get some information. The best information is if you submitted cases and the clients then hear that they get a resolution. That's the way we'll know that things happen, and please let us know where there's been resolutions. And for a bunch of you who are really adventuresome, we had a fisticuffs with HSBC senior managers on Monday late afternoon. It was a fiery call, and people were very articulate, very clear about the cases. They challenged HSBC's interpretation repeatedly of what was happening in the field. It was, I think, excellent work. There were some legal services attorneys on as well, but housing counselors and the attorneys were all did just an excellent job. The HSBC committed to review the cases with the counselors and the attorneys, and they reluctantly but did agree that they would review their policies about ending this practice of just offering 6-month forbearance agreements and terminating them after three attempts, and requiring for many people large upfront payments of cash, and instead doing long-term modifications. We're not making any promises that they're going to have a huge changeover, but this is, but we will keep pushing on this, and hopefully with pressure from the Fed, there may be some progress on that front. Good. Just wanted to also take a moment and acknowledge we've gotten a whole number of new members joining NHRC, the Champlain Housing Trust in Vermont, Housing Action Illinois, a great statewide network, CEI, which Laura and Jason have been on our calls and participating a lot, Campesinos Sin Fronteras, which is an excellent group in Arizona, the Greater Washington Urban League, very large presence in the D.C. metro area, and Long Island Housing Services, which has a good long reputation for doing work here. Glad to have you all in, and want to encourage groups to join. We're now getting more uptake on getting people to use the credit report service. It's a deep savings for almost every agency out there. If you're doing tri-merge credit reports, most people are paying $12 to $18 per report. These are $9.75, and these are soft pulls. We've had several questions recently about hard pulls and how come it hurts people's credit when they pull the credit reports. We had a wonderful webinar last Monday afternoon from CIS, which was about reading how credit scores work and how you can help your client improve their credit score. Some of the stuff is counterintuitive. And that's the credit service that is providing the discount with us. We had several questions there about the hard pull versus soft pull. All these credit, if you're doing it through our program, these are all soft pulls, so will not impact people's credit score. There are other discounts as well, but hey, the reason people are joining is because they want to support the movement and really elevate and strengthen housing counseling. We really appreciate that a lot and want to encourage others to join. So we are going to run out of time here. We will get back on our regular schedule for these calls next month, and we'll do a deeper dive on some of the issues emerging with HUD. And we also have had a task force working on what should the new name be for housing counseling, and we'll be able to talk to you about that in the next session. Thanks so much, everybody, for all the great work you're doing out there. Thanks for all your participation. I think we're moving the dial forward on a lot of important issues, but heaven knows we've got a lot more to do. Thanks a lot. Bye.